Startup Valuation Calculator, How to Estimate Your Startup's Value. Hello, I'm Anna from Valuation for You. If you're building a startup and planning to raise funding, one of the first questions investors will ask is simple. What is your company worth? This is known as your startup valuation. But for many founders, calculating a valuation can feel confusing. There are different methods, different formulas, and different opinions from investors. That's why many founders start with something called a startup valuation calculator. A startup valuation calculator is a tool that estimates what a company might be worth based on key information about the business. Instead of hiring consultants or spending weeks building financial models, founders can input their business data and receive an estimated valuation range in minutes. But to understand how a valuation calculator works, it's important to understand what actually determines the value of a startup. One of the most important factors is revenue. Revenue is often the starting point for many valuation models. Investors frequently use revenue multiples to estimate company value. A revenue multiple simply means multiplying the company's annual revenue by a number that reflects the industry, growth rate, and risk profile of the business. For example, imagine a software startup generating 1 million euros in annual revenue. If similar companies in that industry are valued at 5 times revenue, the estimated valuation could be around 5 million euros. However, revenue alone does not determine startup value. Growth rate is another critical factor. A company growing at 80% per year will usually receive a higher valuation than a company growing at 10% per year. This is because investors are focused on future potential. They want to know how large the company could become in the coming years. Another major factor is industry. Different industries have very different valuation benchmarks. Technology and software companies often receive higher valuation multiples because they can scale quickly without large increases in cost. In contrast, businesses that rely heavily on manufacturing, inventory, or physical assets may have lower valuation multiples. Market size also plays an important role. Investors often evaluate the size of the opportunity using 3 concepts. The first is total addressable market, which represents the total possible demand for a product or service. The second is serviceable addressable market, which represents the portion of the market the company can realistically serve. And the third is serviceable obtainable market, which represents the portion of the market the company could realistically capture. Startups operating in large, fast-growing markets are often valued more highly because the potential upside is greater. Risk factors also influence startup valuation. Early-stage companies naturally carry higher risk. There may be product risks, market risks, competition risks, or execution risks. Professional valuation models attempt to adjust the estimated value of a company based on these risks. This is why many valuation calculators ask questions about things like management experience, product development stage, customer traction, and competitive positioning. Another important concept is valuation methodology. Professional valuations rarely rely on a single method. Instead, several different valuation approaches are usually applied and compared. For example, one common method is the discounted cash flow method, often called DCF. Discounted cash flow estimates the present value of future cash flows that the company may generate. Another method is market multiples, which compare the company with similar businesses in the market. There are also startup-specific valuation methods such as the venture capital method, the Berkus method, the scorecard method, and risk factor analysis. Each method approaches valuation from a different perspective. When multiple methods are used together, they provide a more balanced and reliable estimate of company value. This is why professional valuation reports often apply several valuation methods and then calculate a weighted average. Another important thing to remember is that startup valuations are not exact numbers. They are estimates based on available information and market conditions. The final price investors are willing to pay for shares in a company often depends on negotiation, investor demand, market conditions, and strategic factors. 2 companies with similar financial metrics may still receive different valuations depending on timing or investor interest. For this reason, valuations are usually presented as a range rather than a single number. A startup valuation calculator helps founders estimate this range. Historically, preparing a professional valuation required hiring corporate finance advisors, accountants, or valuation consultants. The process could take weeks, and the cost could easily reach several thousand euros. Today, financial technology is changing that process. Automated valuation engines now allow companies to enter their business data and generate professional valuation reports almost instantly. For example, at Valuation for You, we built a valuation engine designed to make professional valuations accessible to founders and growing companies. Instead of spending weeks working with consultants, founders can enter their business information and receive a structured valuation analysis in seconds. The platform applies multiple professional valuation methods and produces a clear valuation range that can help founders understand how investors may view their company. There is also a free startup valuation calculator available, allowing founders to quickly estimate their company's value before generating a full report. Because the process is automated, valuation reports can be generated in under 60 seconds. This dramatically reduces both the time and cost traditionally associated with professional valuations. Valuation reports can be useful in many situations. They are often used when preparing for fundraising discussions with investors. They can be used internally by management teams to track company value over time. They are used during due diligence when investors or acquirers evaluate a business, and they are used in mergers and acquisitions when companies analyze potential acquisition targets. Understanding your company's valuation helps founders make better strategic decisions. It helps determine how much equity to give investors. It helps evaluate acquisition offers, and it helps founders understand how business performance affects company value. If you'd like to estimate your startup's value, you can try the free startup valuation calculator at www.valuation4u.com. If you found this video helpful, like the video and subscribe for more clear and practical guides on business valuation.